Hey there, YouTube. Thanks for joining today. We're going to unpack some questions that you guys asked, as well as we're going to go into some things about some bank ETFs, copper ETFs, data center ETFs, utilities. Earnings season is coming up, so we're going to be talking about that as well. So that's going to give us some opportunity for some put plays, and then we'll get into where the market may be headed. So with that, let's jump in. As always, this is not financial advice. Looking at last week, we didn't really have a whole lot because of the government shutdown. What was supposed to be a big week on Friday, they didn't post payroll, so we have no idea. We're now flying in the dark. We're flying blind. We don't know where things are headed from a payroll perspective. It's interesting because I've been waiting for this report, especially this one and next month's, and all of a sudden we have a government shutdown. Kind of interesting because 8 months ago we had the government employee layoff, the furloughs and things like that. And so we had 300,000 or 400,000 people, and I was really looking forward to this week's report to see how many of those people have found jobs. Isn't it ironic? We don't have that report. So I guess we'll have to wait till next month to see that. What we do have a little bit of insight with ADP. ADP reported on Wednesday. Take a look here. 32,000 negative job growth. All right, so they were expecting 50K jobs add, ended up having a negative 32. That's the only insight we have. Manufacturing was better than expected at 49.1, where consensus was 49. Remember, anything less than 50 means it's contractionary, but it's very minor at this point. I would say that's more neutral. Back on Tuesday, 7.2 was the consensus. We came in right at expectations. And then Friday, we got nothing, which was a bummer. All right, so let's jump into your questions. So I had a couple of questions last week. And again, if you have questions, feel free to post them in the YouTube comments, and I will do my best to answer them next week. But 2 questions came in. First one was, okay, watched it from start to finish. Thank you very much. And my question is, for any index that's based off of bank stocks in a rate-reducing environment, what would you do with those? It's a great question. I really like this one, and then I'll get back into this one here in a second about data centers. But first, let's jump into the banks. So the way banks make money, 2 ways. There's interest income and non-interest income. What I'll focus on right now is the interest income portion because that's the biggest part of where banks make money. You have 2 sides of the balance sheet. You have deposits and you have loans. And this is, let's say this is made up of checking, savings, and over here you might have money market accounts. Over here you might have certificates. And then you might have a small sliver of borrowings. This is, think of it like the Federal Home Loan Bank, things like that. So this is sort of the makeup. This is called your deposit composition. And over on the loan side, you have the same thing. So you may have something that looks like this. And each bank is different depending on what their philosophy is, what their culture is. But you may have this one's auto loans, 50%. Let's say this bank has 50% auto loans. And then you've got some mortgages over here, maybe some commercial lending, and maybe you have some bonds and stuff that they bought with excess cash. When you look at this side, going back to the deposit side, checking and savings accounts have low interest. Sometimes checking accounts are free. Banks don't pay interest rates on checking accounts. So if the bulk of your money is in checking and savings where you're earning maybe 0.1, 0.2%, we'll call that practically free. So you've got a big chunk of their portfolio is made up of free money. And as banks borrow money from depositors and then they lend it out. So money markets, you might be, say, 1 to 2%. Certificates, you might be 4%. Back in the day, last year, you might have been north of 5%. And then borrowing, say the Fed or the Federal Home Loan Bank, you might be around 4% as well. Okay, on the loan side, you may have autos that might be, let's call that, say, 5 to 7%. You have mortgages that might be 6 to 7, maybe 8%, depending on when you got the loan. Commercial, maybe the same, 6 to 7, 8%, somewhere along in there. And then bonds, this just could depend on where they buy the bonds at. But if they're buying bonds today, you might see 4 to 5%. Last year, you might have saw 6%. In years past, you might only have 1 or 2%. What they do is they take all of this, and this becomes a weighted average rate. And this will be something like 6%. You take all of these loans and bonds, And this is the investment side. Its yield on earning investments might be 6%. Over on the deposit side, remember, half of our portfolio is free. You're not paying anything for those borrowings, and then you have money market certificates, and this weighted rate might be somewhere around 2 to, let's call it 2.5%. The difference between these two is known as your net interest margin. So in this case, your net interest margin is 3.5%. So that's where banks make their money. If you were to look at a chart and you look at the yield curve back in the day, and currently we have something that looks like this. The front end of the curve is still, it's actually getting flat, but last year it was looking like this. This year it's kind of like this, where you have the front end of the curve maybe paying 3.9, 3.6 if it's a 2-year, up to 4% on the 10. So call that flat. Where the banks make money in a falling rate environment is like this. The front end of the curve drops down, it goes up like this. So let's say now the depositors are going to be paid less because all of these rates are going to be coming down. Certificates, I think the days are gone of having 5% certificates. So you get this down to 3%. You get this down to 1 to 2, maybe even 0.5%. Again, this is free, and your borrowings from the Fed and Federal Home Loan Bank, those get cheaper. So this part here is where the bank borrows money. It's either from their depositors or the Fed. And then over here is where they loan out. If their mortgages and things are paying 6%, this is your refinance. Think of this as your refinance cost is going to be dropping. This may eventually go down to 1. Let's call that 1%. Look at this, and this stays up here. There's that spread just gets wider. It just gets wider and wider as the rate cuts come down. If you have too fast of a drop in rates, you have other problems. Prepayment speeds being one of them. Think about this. If you got mortgages sitting in here and all of a sudden this part of the curve comes down, this part right here that we were just talking about, if this comes down to 4%, guess what's going to happen? Everybody who got this, if rates come down 1.5% on the long end of the curve, if it drops down to 4 or 4.5% like it was a couple of years ago, you can bet that this part of the curve, everybody's going to be refinancing. This part of the curve, refinance. Credit cards gets cheaper, refinance, and guess what? Auto gets cheaper. So all of this now is cheaper. People are refinancing, and the income doesn't stay high forever. It'll eventually price its way down, just like the front end of the curve prices its way down. If it comes down slowly, on the front end side, this is going to be very healthy for banks. So therefore, your bank ETFs are going to be good investments, in my opinion. Take a look at some of the ETFs out there. I've played with some of these, especially KBE. I've played with this. This is your regional banks. KBWB, FTXO, and GSIB. I guess this is a newer one. I haven't played with this one, but KBE, if I'm going to be playing regional banks, and I do think it's going to be positive, look at some of the bank stocks already. They've done very well this year. And if you want to diversify, this may be a good play, and it's paying a decent dividend as you sit and wait. So this one may be a good one to sell some puts on and then work your way into it. So instead of buying 100 shares outright, for me, I would be selling a put at a 20 or 30 delta, which is just maybe a slightly below where it's currently at, and collect the premium. If there's a retracement in the market, then you get picked up at that strike price, and then you also get paid to buy the stock. So that's a really good way to enter bank ETF. So great question. Thank you for that question. Look forward to seeing some more. All right, so for our next question, I'm trying to bounce around ideas on the AI trade outside of the chips market. Good idea. And I landed on a few options. I'm curious your thoughts. Data center REITs, can't find too many of them other than DTCRs because there's not that many. Tons of refrigerated rents for food and drug, but not many data centers, true. Optical fiber material companies, yep, and satellite comm companies. I don't know too much about these, but let me know your thoughts and plays if you have some. I have another one for you besides a data center, and that'll be copper. So what's it cost to search something? So when you do a Google search, they're highly optimized. It costs fractions of a penny. There it is, 0.0003 per kilowatt hour, less than a penny per Google search. However, if you do an AI search, it goes up quite a bit. So 0.0029 on cheaper models like ChatGPT. But if you get into some refined models like Gemini or DeepSeek and others, you're going to be looking at somewhere between 1 and 10 cents per query. So the power demands are a lot higher for a AI search versus a typical Google search that everybody's used to. Now, I'm a big believer in AI. I love AI. I use it all the time. I have subscriptions to AI models. What I love, like if you look at Perplexity, I use audio.ai. You can type in a search and then you can say, hey, auto select, and it'll go pick from 15 or 20 different LLMs and let it do the search for you. Or I like Gemini, so I use Gemini a lot, Gemini 2.5, and that does a lot of my searching, and it is fantastic. I'm a huge believer in AI, and I really like where it's going. For those of you that are earth friendly, the Google search has very little carbon emissions, whereas the AI models on this side a lot bigger. So those that are earth friendly, think about that the next time you type in something in AI. Let's look at the demand. So in 2024, this is your data center demand for power, 33 gigawatts for all data centers. 4 of that was used for AI. Fast forward 10 years, 123 gigawatts just for AI. And then you can have the other total demand for just data centers in general. 176 gigawatts of power that's going to be needed, a 30-fold increase. That's giant. So 5-acre data centers, which are what is out there right now. Think about 5 acres. A 5-acre data center, that's a pretty decent size. They need 5 to 50 megawatts of power. In the future, this is really mind-blowing. 500,000 acre campuses. I know that's like a giant number. I don't know where they're going to build those, maybe New Mexico or somewhere out west or maybe global places, but 500,000 acre campuses, they're going to need 5 gigawatts of power or 5,000 megawatts of power. That's huge just for one facility. And there are plans to build these 500,000 acre campuses. That's just a mind-blowing number. Take a look by where we're at today. These are some of the infrastructure projects for data centers and the power that's going to be needed. This is what's completed: Ohio, Oregon, Iowa. Under construction, some pretty big plans for Ohio at 1.4 gigawatts for their data centers, Tennessee at 0.7, Missouri 0.4, and then that's currently under construction, then what's planned and what's coming up. Look at Louisiana, 2 gigawatts. Look at the map across the United States for data center consumption. What's current, the black is what's current, the green is what's planned. Texas, they are doubling in size for their gigawatt power needs. Look at Louisiana. Look at that little tiny little speck there of gigawatt power, and look what's planned. So that's what we just saw on the previous slide. Look at the Northeast, big needs for power. I think you know where I'm going, and that is power and utilities, copper, things like that. So from a ETF REITs perspective, so I just pulled up 3 different REITs. DLR, Digital Realty Trust, they are data center type company. Equinix, and then American Tower. All these are related to data centers in some form or fashion. And then I plotted this blue line here. This is SPX. And then this is the performance of these individual companies. We'll get into the ETFs here in just a second, but just individual company performance. AMT, I think that American Tower didn't do so well. And then the others, going back to 2022, 23, you can see SPX definitely outperformed these individual companies. But if you want to spread it around, because Mag 7 is really what's driving the performance of SPX. If you want to get away from Mag 7, this may be a way to do it. And maybe sell some puts on this. Looking at the ETF side, DTCR is the data center ETF. That's really about the only one out there. Good one here, but it only performed at 35% compared to the SPX in the same time frame at 67. Again, if you want to diversify. And then this guy here, Pacer, Data and Digital Revolution. I don't care for this one much, even though it's really outperformed, but this is primarily NVIDIA, Oracle, and those bigger type companies. 30% of their ETF is made up of 3 companies. So there's going to be some volatility in this one. But the data center ETF, not a bad play, especially if you want to get away from these guys, the NVIDIAs of the world, and not have the volatility. I think this is going to be a good investment over the long run, given the demand that we saw for data centers, and everyone is using AI now. If you're not using it, try it out. It's amazing. Even if you go to Google search, it'll say you want to search and deep dive in AI mode. There you're using AI. But if you subscribe, like I do, highly recommend it. It is very powerful. All right, so let's go into copper a little bit. Data centers use about 5 to 15,000 tons of copper each. Microsoft just built one in Chicago. They use 2,400 tons of copper. $500 million facility, 2,400 tons. By 2030, the expectation is 330,000 to 420,000 tons of copper annually will be needed at that point to keep up with the data center construction. So huge needs. Look at copper ETFs. These are some of the ones that I have played with, COPX specifically. Look who they're using, FCX. FCX actually came up on my play a couple weeks ago. We'll talk about that here in a second. ICOP, COP-P, COP-J, COP-A. All of these have FCX except COP-J. I didn't see FCX in here, but this is their breakdown of the copper miners. These are ETFs, and these are performing quite well. If you look at SPX, SPX is the blue. So going back a couple of years, SPX is 40%, and then take a look at COPX, 68%. Now, what I like about these is higher implied volatility. So if you're selling puts and options like I do, you could go out and buy SPX directly, or you can go buy COPX directly. But if you sell options like SPX, right now there is no volatility. That means premiums are super cheap. If you're an options seller, you're not making any money. Whereas COPX, if you go look at their implied volatility, it's twice of what it is on SPX. That means for the same amount of capital, I can make twice as much just selling options on COPX. So probably a better play on COPX. And with the copper needs that is coming up, I don't see how you could go wrong with it. Now, that's not financial advice. This is just my opinion. And this is why I am playing copper. All right. So yeah, higher implied volatility. Great performance, keeping up with SPX, and juicier premium for sure. Another play for data centers is utility companies. So XLU is the sector spider that represents utility companies. Think about all copper needs. Think of power generation. Utilities have done very well this year. Take a look at that. They also have a good dividend. Right now it's roughly about 3.2%. And the price has done extremely well. Very cheap from an ETF perspective, only 0.09% expense ratio. Great thing. And I have played with XLU in the past. All right, so what's coming up next week? Take a look. Really not much. With the government shutdown, there are no reports coming out. So we're going to be flying blind for a little while. You got the FOMC meeting minutes coming up. That'll give us some insight. We already know how Bowman voted. We know how Lisa Cook voted. We know the new guy, Myron. We definitely know how he voted. But we'll get some other insight into what was going on in the room that day. This is crazy. September, 3.5%, 3.53% for the month of September. September is usually the worst month of the year, not this year. And it just keeps on going up. Right now, we rolled forward one quarter. So if you look back here in September, when I did this before, it was 284.20. Now we're at 293.97. What that means is we rolled off the last quarter, because this is looking forward 4 quarters. And if you take all the companies in the S&P and the analysts do their thing and figure out what the earnings are, the forward 4-quarter earning expectations is 293.97, which means the PE is 22.84. So if you notice it fell, that's not a bad thing. It's just that we dropped a quarter and we moved ahead the next quarter. But look at the seasonal trend. Still have it up here. It didn't drop. It didn't fall like it normally does. I did short in between each one of these, but knowing that it wasn't going to be a big short, I just took the profit and ran. I didn't hold for a big short. I'm still waiting for a pullback. What I've done in the meantime on IWM, this is small caps. Remember, I've mentioned small cap stocks will do better than large caps. So should outperform SPX. The reason that is because we're in a rate cutting cycle. They are more debt sensitive, so they're going to perform better as rates come down. That's just a general broad thesis. So what I've done is I'm planning on buying them at 235. Right now they're 244. They were back at 239 last week sometime. When they were about that 239, 240, I thought, I'm going to go long anyways. So why don't I sell a put at 235? And then if it comes down to me, great. I'll pick it up at 235. I get paid my dollar, whatever it is, or $100 per contract. I'll pick that up. That premium I get to pick up. And I'll just wait. And if worst case scenario, it doesn't come back to 235, that's okay. I'm going to get paid while I wait. That's going to be my play. That expires in 2 weeks, and that's October 17th. If October 17th we've had any sort of pullback, I'll do it again. I'm going to keep selling puts on IWM, waiting to get picked up. The only unfortunate thing is if IWM continues to go up, then I will never be able to participate in all that up. But I will get the premium every single month. So I'll do that until I get exercise. So if it goes up again, then I may sell a put at 240. If it goes up more, I may sell a put at 245. I'm just going to continue doing that until it comes down and meets me and I get exercised. So I like that approach. I do think we're going to have a pullback. When? I don't know. I'd like to think it'd be in the next couple of weeks, just following this trend. And then usually October to December is typically a good time of the year, as you can see here. A couple more things before I go to the next part. SPX, 1.52% for the week. IWM, 1.9%. XHB, the housing stocks, great. AGNC, 2.76%. DLR, 2.56%. So the data center. TLT, 0.5. This is nice because what I've been doing on this one, TLT are your 20 and 30 year bonds. What I'm doing on that, and if you want, just shoot me a note in the comments if you want a little bit more detail on this one. But I am straddling the 20 and 30 year bonds, which means I'm selling a put and a call. And because TLT or 10 year, 20 year, 30 year bonds should not move that much unless there's a major recession coming. Right now, I do believe one is coming, but not in the foreseeable future. So what's happening is rates on that long end of the curve are fluctuating 10 to 20 basis points. So as long as they stay in that range, I'm giving myself about a 25 basis point range, maybe 30 basis point range, and I'm just doing that every single week. Wherever it is, I center it up, and then I collect premium. And that's actually been working out very well while I wait, because if I buy it, I'm just going to sit and hold and collect 3%, or right now, I'm probably making about 10 to 20% selling the puts and calls. So 10 to 20% every week. Actually, yeah, 15%. It's about 15% every week, which sounds like crazy. Again, I'm not taking the whole portfolio and putting on this. I'm only taking a part of the portfolio. But 10 to 15% a week on that piece that I'm putting on it, it's working out quite well. As long as it behaves right and doesn't move. Again, if you want a little bit more detail, shoot me a note and I'll do a little bit more brief on TLT. XLU, that's the utility stock. That has done very well this year, 2.5% for the week. All right. This is the commitment of traders. I haven't shown this before, but look, so going back in April all the way up till now, this is by week, each week. Commitment of traders is what hedge funds are doing and other institutional investors. They are net short. So I'm not the only one who is thinking that it was overpriced. Look at this back in September time frame. I don't have the date here, but this is September. Increasing shorts, and look, the price went up. So this is definitely not a predictor. It's just letting you know what institutionals are thinking and people like me. So I'm sitting here shorting the market. I took profit each one of those little drops, but yeah, the market just kept plowing forward. So I'm hoping that we do have a pullback because it's very strong momentum. Any pullback I'm going to be adding, unless the data shows something completely different, like unemployment goes through the roof, then I may change my perspective. But for now, that's what I'm going to do. Now take a look at, this is the seasonal performance. This is going back 10, 11 years. Look at September, 3.53. September of last year, 2%. And then look at all these negatives going back in the years past. This is why I was interested in shorting, because look, most of it is negative or very little growth going back 10, I think it was 11 years. I think it went back to 2014. So October last year, 0.41. And then you can see October can be a nasty month as well. So keep an eye on that. And with market being as frothy as it is, it's trading right now 4 standard deviations above the mean. So I think it's frothy. I do think it has some opportunity to return. A little bit, I would like a little bit. This is just, to me, way too expensive to buy. Now, if you're a buy and hold and you're dollar cost averaging in, keep doing that. That's the best thing you can do. But for a guy like me who likes to, I shouldn't say time the market, but I like to sell options and collect premium that way. So I guess in a sense, I'm timing the market. I'm going to wait for a pullback. I will wait for a pullback before I add. All right, so we talked about this the last video. We're almost done. Put sales. So I did play some of these. I played Newmark, I played Nike, and FCX. All of these worked out except FCX. FCX took a bath. And this is why I always recommend hedging, because they took a big bath at $43. I think the stock was at $45. I sold $43 puts, and then I bought $41 puts. So that gave me a little bit. I gave up a little bit of the premium. I think I was making $20 because the $20 per contract. Again, it's not much, but when you're only using a $200 investment and you're making $20, that's 10%. I'll take it. And when I say $200, now that's per contract. You could do 10, 15, 20 of these, whatever you want to do, whatever you want to allocate to it, by all means. But I do like to diversify, so I'll play a little bit of this one, a little bit of this one. And you know what? The law of large numbers, by the time you add up all of them, then it works out. And diversification is key when you're playing the stock market. So I did 5 of these contracts. So it wasn't much. I risked $1,000 and was going to make $240, $200 on a $1,000 investment. So not that big of a position. I'll get into that in a second, what I did, because it did tank. All right, but what's coming up is this. Look at some of these expected returns. Premiums are juicy because earnings are coming up the week after next. So bank stocks don't report next week. They report the week after. All of these are to expire next Friday. And these are the implied volatilities, which these are all higher than the norm. Let me jump into that here real quick. All right, so looking at Wells Fargo, you can see that this white line here represents the implied volatility. This is historical volatility, this orange line. What this means is because earnings are coming up, people are willing to pay more to protect their position. As an option seller, this means that options are overpriced compared to their historical. I'd be willing to play a bank stock in this case and collect some premium. Juicy premiums here. Take a look at Schlumberger, same thing. They've got earnings coming up in a couple of weeks. Look how much more expensive with this implied volatility here. Look at GE, earnings coming up, and look how expensive those premiums are getting. So implied volatility is well over historical volatility, and 9 times out of 10, it just means they're overpriced because stocks don't move as much as people think, but they are willing to pay more. As an option seller, again, that actually works out well in my favor. All right, let's talk about FCX. So FCX is now 39.67. This is making a recommendation at a 38 strike to get a 2.89 if you were to sell a naked put, but you can actually do better than that. You can probably get north of 10% if you did like a 38.36. But let's talk about what happened this last week. So if you've read the news and you saw FCX stock, it tanked. And that was because they have this mine in Indonesia, the Grasberg facility. They had some sort of mud cave in, and they're saying that their production is going to go offline for a quarter, and it was going to be a 35% hit to their earnings. And that's what they came out with on the day after. I ended up selling my put like right here, and wouldn't you know, it just always works out that way when I get into the market, and then bad news comes out and it tanked because the earnings expectations is going to fall. The thing is, though, this is probably overdone. When you look at the Grasberg mine, there's 2 sites within the Grasberg mine. The other site within that Grasberg district has 27 billion pounds of copper. So FCX is a copper miner. We talked about copper a minute ago. FCX is one of the miners, one of the big companies out there pulling out this copper out of the ground. Just because it lost 1 quarter of production doesn't mean that it's going to be a long-term hit to FCX. It just means that it got delayed. There's several years worth of production coming out of the ground. And so this was well overdone, and now you can see the stock's returning. So what happened here is when this tanked, the $43 put that I had a 43 and a 41, so I had a $200 spread. So I did 5 of these, so that means I was out $1,000. Because what happened is it blew through it, and yep, I lost the maximum minus whatever I got. 1,000 minus the 20 cents I was going to get for 5. So technically I'm down 900, right? Because I got 5 contracts, 20 cents a piece, $100 there. This gave me $1,000 difference in between that. So what I got for the premium means I lost 900 because I got paid 100. So it fell all the way down to $35 right here. But if I had 5 naked contracts, meaning I just sold 5 puts, that would have been a huge hit because I sold those at 43 down to 35. That would have been $800 per contract. So at 5 of those, you'd have been down $4,000. I'll take the 900 instead of the 4,000. But what I did that day in order to help make this back is looking at the data. I thought the copper's still in the ground. Yes, they're going to go offline for a quarter and they're going to lose that copper for that quarter. But starting next year, they're going to be pumping it back out of the ground again. I bought a $35 put to protect against further downside. And then I came up here and I sold a $38 call. Options were super rich. This cost me $370. The minute it goes right back up here and it goes beyond that, yes, I capped this part of the profit here, but I didn't want to pay too much for this insurance because if I just bought, this would have been maybe $500-$600 to keep going. I just lost at $900. If I go spend another $500 to protect the position, I'm going to be down $1,500. Didn't really like that, so let me just spend $370. And if it comes back into this range, I get to make all this back. $2,000 minus the $370. So not bad, right? That's just working my way out of it. So I protected further downside, sold this guy to help pay for this, and then made money back coming this way. So that's kind of how you work your way out of it. And you can hold on, and if it comes back down in here, then do it again. Buy another put, sell another call. And then that way, I do think the price will work its way back up. So that's just in a nutshell how I worked out of that one. If you want a little bit more detail, shoot me some notes in the comments. And that is it. It's a long video, but I hope you guys found it helpful. If you have any more questions, please drop them in the comments on YouTube, and I'll be glad to take a look and try to answer those again next week. I enjoyed doing this, so please let me know that if you like it as well. Thank you very much, and we will see you soon.